a word that has been in my head for some weeks now, and that is stagflation. Is that where we are right now?
I think it's too soon. I think we have to go back to looking at the second half of 2023 and the data that we had. So when we see the third quarter and the fourth quarter, we had really strong GDP. We also saw disinflationary forces that were really, really strong and better than anticipated. Q1, you saw a little bit of normalization, right? So you saw inflation not coming down, CPI certainly not where we wanted it to be for Q1, but I would call that more normalization. Even the GDP print that we saw that came in below expectations, when you factor out imports and you factor out inventories, all of a sudden it looks like a pretty solid GDP print. So I think this Q1 was about normalization, and the data in Q2 really matters for the Fed's trajectory from here and the overall economic backdrop.
Jim Caron, the fall off or the runoff from $60 billion a month to $25 billion may have been a little bigger than some people expected. React to that, and what in a practical sense does that mean to the markets and to consumers and the general public?
Well, look, I mean, I think Rick summed it up. There isn't much of a move in the rates market right now, and I think that's exactly what we should be focusing on. We're anticipating that the Fed's balance sheet is going to adjust, and I also think that a big balance sheet is a form of easy policy, so I think this does need to adjust over time. But Tyler, let me go back to what I said before, which is that this is really about resetting the clock for the Fed. When do they start to get confidence that they can actually start to cut rates? And this is the debate that's in the market at this point. So the debate is whether or not they, if you go by market pricing, is the first cut in December, where many forecasters still think July. And I think the fly in the ointment is going to be the labor report. If the labor markets start to weaken, I think that advances the time scale for the Fed to start to cut earlier. But if the labor market stays strong, I think that they're going to stay on hold probably until December.
All right, so Steve Leisman, let me just get any further thoughts that you might have, having a little more time to read the statement and pull your thoughts together.
Well, I have a hard time seeing this as stagflation or in any way, shape, or form. Stagflation is high unemployment. It's high inflation. It's no growth. We are so far from any one of those three. Not that it couldn't happen, but stagflation assumes something is sort of broken in the price mechanism in the economy. And what would be broken there would be that if you do have weaker growth, prices would not adjust downward. We don't know if that's the case. I just think we're a very long way from stagflation. As for the Fed, I would say this statement reads to me like a plane that's circling. They're waiting for time. They've acknowledged there are a little bit of turbulence in the air there. They perhaps see some fog on the runway. So they're not quite ready to land yet, but I do think they want to land this plane. I think they're still on course to try and land the plane, Tyler. It's just that this is a holding pattern, this statement here, before the data either breaks towards weaker growth and lower prices, and or you get a move higher in inflation, which would engender a different kind of response from the Federal Reserve. But what the Fed is doing here is essentially holding.
David Kelly, let me get you to react to what Steve just said. Are we far away from stagflation? Are we nearer to it than might be comfortable for the Fed? What do you think, or is that really just not even on the table?
No, I think I completely agree with Steve. We're very far away from it. I mean, we've got unemployment below 4. We've got consumption deflator inflation below 3. 3 plus 4 is 7, but 3 plus 4 is also good. These are good numbers for the U.S. economy. Growth is slowing, but it's slowing at a modest pace. So really the economy is fine here. There's nothing wrong with the economy. It's just all a little too hot for financial markets who are banking on big rate cuts from the Federal Reserve this year. But even the statement, I think the one thing that strikes me is they could have cut the Treasury runoff from 60 to 30. The fact that they went that extra $5 billion, it probably doesn't sound like a lot, but it does say that they're trying to send a message here that they're not going to be too hawkish here. So if anything, I would regard this statement as being slightly on the dovish side, and it gives me more confidence that they won't hike again, but they will eventually cut rates this year.
I'm going to come back to all of you or several of you on a terminal question here about the terminal rate of interest rates. But Rick, let me just turn back to you for any reactions you have.
You know, to me, it's not that my sources or many people I have confidence in to gauge the future of the economy are saying stagflation's here. What they're saying is it's a rate of change argument. It's impossible to look at the GDP report and not say that growth is slowing, the rate of change is slower. So, yes, the economy's fine, but it's much less fine than they thought it would be. It's much less fine than the previous quarter. And if you looked at the pricing components in the last GDP report, inflation, the rate of change, is moving back up. So it isn't that stagflation's here. It's that you can't put your head in the sand, okay? We had guidance from a dovish Fed that was very wrong, okay? Didn't hear much grumbling about that. But to have forward-looking notions regarding the glide path and rate of change of the economy that may point to stagflation, that to me makes sense, and I don't think we should ignore our eyes. Our eyes aren't lying. Things are slowing but still growing, and inflation stopped going down. You could call it anything you want, but what you can call it is a reason to ease.
How about what Rick just said? Who would like to react to that?
Well, I'll say something. Just briefly, just from the stock market's point of view, I cover the stock market here. The reason the S&P was down 4% in September was not because people were concerned that earnings or the economy were falling apart. The concern was higher for longer interest rates would bring down the multiple. So instead of 21 times forward earnings, we went down to 19 and change because higher for longer, of course, impacts future stream of earnings or the perception of the future stream of earnings. Now, if there is some kind of slowdown in the economy, which we don't see yet, or the job market slows down, then the earnings numbers themselves are going to start coming down, and that's a whole other scenario.
Yeah, but Rick says we are seeing a slowdown in the economy. Rick said you've got to look at the numbers. They are slower.
Here's the thing.
The jobs numbers, which is what matters, are still pretty robust.
I'm going to let Steve jump in and then Jim. Steve, go ahead.
I'll keep it quick. The idea of stag, that means stagnant. It means we're not growing. A slowing in the pace of growth is what we all have wanted. It is the soft landing scenario. So it would seem a little bit extreme to me to jump from we got the slowdown we wanted to the idea that the plane is stalling and about to crash land. Look, I think Rick is right. You got to factor that into your possibilities. I just don't think it's the most probable outcome because of what you expect to happen with prices in that scenario. In the scenario of stag, you get D, not inflation.
All right. Well said. Jim, I want to get your final thought, and then I'll go one more time to you, Kristen and David. Jim?
So look, I think it's premature to talk about stagflation, but there's a lot of noise out there, so let's focus on the signal. Tyler, you were going to talk about the long-term terminal rate. I call that the forecastable horizon of Fed policy rates. What the market has been very stable on is that the market still believes that the Fed policy rate's going to 3.5% to 3.75% sometime by 2026. How we get there, how quickly we get there in 2024 and in 2025, there's going to be a lot of debate about that, and there's going to be a lot of noise. But what keeps the market stable, equities and fixed income, is if that longer-term forecastable rate stays stable. And right now it's staying stable despite all the confusion in the markets, and that is actually a blessing for asset prices at this point. If that rate moves higher, that could actually spell problems.
So that's where I wanted to end things. And that, Kristen, why don't I turn to you about that long-term terminal rate for interest rates. Jim just said 3.5, 3.75 by 2026. That's a little higher than we've been accustomed to over the past decade and a half, but maybe it's just not too hot, not too cold.
Exactly. I think it's higher than what we've experienced, certainly, and it's higher than what expectations are. I think since we've seen resilient growth, and I'm going to go back to something that Steve said, where it was, we are seeing a decline in the growth rate. We're not seeing a contraction. We're seeing a slowdown in growth, which is exactly what the Fed wants to see, whether that's the data that we've seen in GDP, whether that's the data that we saw in JOLTS this morning. And so finding exactly what is that neutral rate and what is that balance is something that I think the Fed is going to take its time, and it's going to do it gradually in terms of the rate cuts that we'll see in 25 basis point increments, that if we get the data from an employment standpoint, we get the data from a disinflationary standpoint, we'll still see maybe even up to 3 cuts this year.
Mr. Kelly, you get the final word.
Okay, I do think the terminal rate ought to be higher because I think that 2.6% is too low for financial markets. But on the state of the economy, I know the numbers are getting a little worse on inflation temporarily, but that's kind of like saying, a teenager gets older every day, doesn't make them old. And so this economy is really much more like a teenager than an 80-year-old right now. It's an economy which is showing plenty of potential for growth. Inflation, I think, is still sticky, but probably trending down. Unemployment is very low. This is actually a pretty good economy for Main Street. Not quite as good for Wall Street if you really want short-term rates to come down to 2.5%. But frankly, I think this is a glass, not just half full. This is a glass about 80% full here.
All right, that wraps our conversation. Thanks to our panel. Lively conversation. We stirred the pot a little bit there. Thanks so much to all of you for your participation today. Really appreciate it.